Hey everyone, welcome back to Streetwise Economics. Real talk, real trades, and real lessons from the markets. Quick disclaimer before we dive in. This video is for educational purposes as well as entertainment purposes only. It's not meant for financial advice. Always do your own due diligence or speak with a financial professional before making investment decisions. All right, grab your coffee, your notepad, and your curiosity, because today I've got the perfect beginner-friendly example of how I made 7% return in under a month using a covered call strategy on Walmart. Now, let's break it down. What if I told you that I bought 100 shares of a solid blue chip stock, got paid multiple times just for agreeing to sell it, and then made a profit when I finally sold it? Sounds like a win-win-win, right? That's exactly what happened with my Walmart trade. And in this video, I will show you step by step how this low risk option strategy works, how I logged in over $600 in profit, and why covered calls are one of the best kept secrets in investing. Let's get into the trade. So here is what went down. A few weeks ago, I bought 100 shares of Walmart at $85.97 per share. That's about $8,597 invested. Instead of just waiting for the stock to go up, I used one of my favorite income strategies, the covered call. In plain English, since I owned the 100 shares, I could sell someone else the right to buy them from me at a higher price in the future. In exchange, I got paid upfront. That's called a premium. And I kept that money whether the stock moved or not. Each week, I wrote a covered call with a different strike price depending on the price it was. I remember it was $87, $88, but at each given time, I was getting premium. And most recently, I then chose a $90 strike price. And this was for a weekly covered calls. So in that case, as it happened, if Walmart stayed below $90, I would have kept the shares and the premium. If it went above $90, my shares would be called away, meaning I would have to sell them at $90 and take the profit. So on Friday last week, April 11th, Walmart closed above $90. And boom, the shares were automatically sold at the open on Monday this week. So this is how the profit breakdown was like. So let's do the maths. I bought the shares at $85.97, sold them at $90. And the gain in that case is $4.03 per share times 100 shares, because one option contract has 100 shares. I got $403 profit. And these are US dollars, by the way. But that's just the capital gain. I also earned about 200 US dollars in total premiums over a few weeks by selling covered call options. So the total profit roughly, I would say in that case, I made 403 from the stock gain plus the 200 US dollars in premium to make it $603. So that's just over 7% return in less than a month on my $8,500 investment. And the best part, it was calm, low stress trade, no chasing momentum, no late night panic selling, just a well-planned move using simple tools. So here is the teaching moment. And now let's zoom out and talk about the basics. A covered call is when you own 100 shares of a stock, and that's your cover in that case. Two, you then sell a call option that gives someone else the right to buy your shares at a higher price by a certain date. In return, you get paid upfront, and that's the premium. So there are two possible scenarios or outcomes in that. If the stock stays below that strike price, in this case, I chose for the last week, Friday, my strike price was $90. Then if then the stock stays below the strike price, you keep your shares and the premium. You rinse, you repeat. If the stock goes above the strike price, like what happened, your shares get sold at that strike price, but you keep the premium and lock in the profit if your strike price is above the average cost for the shares. Now, for me, in this case, it's perfect for investors who want cash flows. Two, people who are okay selling their shares at a target price. This is something that I've learned over time when I'm investing. I want to have a target price to say if my stock that I'm holding gets to a certain level, I'm going to exit. Now, those who want to reduce downside risk while still participating in the upside, this could be something for you. In my case, $90 was the price that I was happy to sell at. So it was a win-win either way. However, of course, no strategy is perfect. There are always risks and rewards, and how you balance those two is what makes you successful or fail. In terms of the rewards, in this case, I earned income even if the stock did nothing in that case. You can also set a clear exit and entry point and get paid while you wait. You can also repeat it weekly, monthly, or even couple of months out and make consistent gains. Now, on the risks, if the stock rockets way above your strike price, you miss out on the bigger gains. Like right now, Walmart was trading at $94 something, right? So it means I missed the $400 in that case. That if I just held up the shares, then I could have made $800 instead of the $600 that I made in a month. But also, if the stock crashes below your buy price, you still own it. And the covered calls can only cushion you for some of the fall, not prevent the losses. So that premium in that case. However, in my case, even if I was owning the shares, right, I would still lose money if that stock was to go to zero in terms of the price. So in this case, I want this consistent way of generating money. So it's not a risk-free, but it's a way more controlled than gambling on a random options play. So my takeaways are that the lessons being the covered call is one of the most beginner-friendly option strategies out there in my experience. And it's not about guessing the market, it's about building consistent income and managing your trades while you have some logic and not emotion. So my Walmart trade made over 7% in under a month with limited risk in my view, using just the basic tool and a stock that I believe in. Again, the caveat is I only do stocks that I understand fundamentally. I do research. I am sure that this stock has a strong balance sheet and great management. That's the key thing. I don't do risk plays. I do only stocks that I would otherwise be comfortable holding, even if the price drops in the short term. So if you are looking to level up your portfolio without going full digging, this is a smart place to start. So in this video, if you understood how covered calls works even 1% better, do me a quick favor, like the video, subscribe to Streetwise Economics for more smart investing content. Drop a comment. Have you tried covered calls before? Or are you thinking about testing it out? Thanks for watching Streetwise Economics, where we make money moves make sense. Stay wise, stay curious, and I will catch you in the next one. Trade and invest wisely, and may the markets be on your side.